We are about to kick off a workshop on venture debt, what founders need to know about it. Before we get there, just want to say hi to everyone. If you could throw in the chat just where you're calling in from, it's always great to see where people are represented. See, we have some friendly faces. Mikhail, are you still in SF? Yeah, good. Let's see what other names we have here. David Lee from New York. Good to see you. London, San Francisco. What's up, Tiffany, in New York City? Okay, no international folks, huh? We don't have any. Okay, we have some Canadians. Good, good. Awesome. So it sounds like we're well represented all around the country, a little bit around the globe. Shaji from Malaysia. Wow, amazing. Thank you for staying up with us. We're going to get into something that's been complicated and on my mind for many, many years. So being able to set this up has kind of been a goal of mine ever since I was in venture. Before we get into it, I want to do housekeeping as always to make sure we're on the same page and we have a great workshop. So some of you have your cameras on, some of you don't. We don't really like lurkers here because this is going to be an interactive session. I'll be interacting with you. David will be interacting with you. So if you could keep your cameras on so we can talk to you face to face, that'd be amazing. And remember, we're going to have open time for Q&A. I'd highly recommend you take notes. A lot of this stuff won't be obvious to you, and you may want to jot down some things that you want to follow up on later. Our workshops are never meant to be edutainment where you just sit back and listen to interesting people chat. These are things that we'd like you to figure out how to make actionable for yourself, okay? Want to encourage you to share your favorite insights on social media. These are things that we want other people in the community to learn. If you tag us, we'll try to amplify your message, retweet, etc. One call out that my team wanted to make sure that I remind everyone is that when you leave this workshop, some of you might leave in the middle, we're going to ask you for a poll to respond to a poll. We'll also send you some information about stuff that we're introducing to the community. So other ways that we'll be able to support you in the future, please look out for that poll, respond to it if you can. Look out for a recap email afterwards. And lastly, we've done now probably over 100 different workshops over the last couple of years. What we found is that the Zoom chat is one of the best places to be. So interact with each other, introduce yourselves in the chat, drop your social media, connect with everyone else, connect with us too. I'm at JEA on almost every platform. And if you find me on LinkedIn, mention that you came to the workshop so I know you're not a complete rando. All right. Before we talk to our guests, just to remind you what this topic is all about. Really, it's the idea in my mind of venture debt. And what is venture debt versus venture capital? I'll tell everyone, let me actually switch sharing. I don't know if you guys have seen this yet, but we have all these different options of ways I can play with Zoom screen sharing now. So I want to bring up my face and talk about this. One of my favorite features of AI is probably something that you haven't considered yourself, but for me, this is really important. I can now think of an image that I want for my presentations and dream up of exactly the photo that I want. And now instead of going on Google image search for hours to find what I want, I can now type on startup founder, casually dressed, wearing a rocket jetpack, where some of the rockets are big and some of the rockets are a little bit smaller in order to represent venture capital versus venture debt. And the story I want to tell about this, which is why I think this workshop has drawn so much attention, over 400 people registered for this, people looking for this recording, is that many of you know that I was a venture capitalist for about 5 years at Greycroft. Looked at hundreds and hundreds of deals, was probably part of nearly 50 deals, some of which took venture debt, some of which did not. And I was in many rooms where the lead partner on the deal would talk about things like, should we add venture debt to this round of financing? Should we not? Almost every single time, the founders would certainly glaze over and not understand what their decision was. And if I had to really be honest, I'm not sure that the lead partner quite understood what he was offering or what he was suggesting. I certainly, as a junior VC, wasn't in a place to really push back, understand. And so it's been, gosh, kind of dating me a little bit. It's been nearly a dozen years since I was back. I started in venture capital. And I figured it was time for me to correct that little knowledge gap and reach out to the community to figure out if we could set up a workshop that would help me selfishly and the rest of you. So that's what we're going to be jumping into today. There are a set of questions that I want us to be able to answer. And those topics are, so what is venture debt? Who invests in venture debt and when? I want to talk a little bit about terms and structure. This is where things get very specific around decision making. And then I want to talk to some people, some special guests, about how they made the decision. We'll try to cover all of this in about an hour. And I certainly couldn't do this myself. Like I said, I don't have the background for it. So we've been lucky enough to find an amazing guest who can help us with this. I just got prepped on how to say this. We have the CEO of Western Technology Investments, David Winek.
David, close. Wanek.
Wanek. I literally had a voice note reminding me, and then I look at the phonetics of it, and it was kind of challenging. David Wanek. We have David Wanek, the CEO of WTI, leading venture debt provider, a brand that I knew quite well while at Graycroft. A lot of you may have learned and heard about. But we're excited to have you here, David. Before we get started, I wondered if you could, we're going to spotlight you, spotlight me. I wonder if you could give a little bit of background on yourself and the firm for the people that don't know the firm and don't know yourself. And then we'll jump into some of these topics.
Sure thing. Well, first, thank you for doing this. I've been doing this for 25 years, and I think it's the first time that somebody has had like a big event like this to really talk about it. I've been on stage a few times now, but 400 people. It's fun to talk about it. It's also it's interesting to hear what you just said about sometimes people didn't really know what they were talking about, even when they were evaluating this at the partner level. So I'm pleased that we're doing this. Background on our firm. We're we think of ourselves as a 44-year-old startup. So the two gentlemen who started our business did it in 1980, and this was in the dawn of the venture capital, the creation of the venture industry. These were entrepreneurs who realized themselves that really the only form of capital that was available to founders was equity capital, and it was really expensive. And back in those days, equity capital was small single digits in terms of single digit millions. That was what was available to startups. And most of those businesses back in those days were building things that were hardware oriented, where either they had to build out fabs to create semiconductors, or they needed to make some sort of computer peripheral part or a medical device. So they were heavy capital intensive businesses. And if you were raising small amounts of equity, if you had to buy a lot of equipment and things with that equity, it didn't go very far. And it was at the same time, traditional lenders wouldn't lend to these businesses without personal guarantees, because it didn't fit the mold of what a traditional bank would lend against, because these were businesses that were not profitable. They were going up against much larger competitors, and they were going to be out of cash in a number of months. And those are all the kinds of things that banks just wouldn't lend to. And so these two gentlemen really figured out, well, wait a second, there's an opportunity here. One of them was a technical engineer and thought there's got to be a different way to think about collateral, and rather than a declining cash balance, what if we can think about the things that these companies are building and what makes them different and interesting. That should be what we think about collateral. We should think about the sum total of the enterprise value of these businesses, not just a liquidity ratio. And really started just making bets one at a time to see, hey, is there an appetite for this kind of capital? Number two, can we actually make money doing this, and can we not lose? Yeah. Does this work? And they spent the decade of the 80s proving it out. Literally, it was kind of like a seed stage fund in today's parlance, where you have a thesis around what you're going to be investing in, and you just try it. And so over the course of that decade, They made a lot of investments, and fortunately they worked and raised more and more capital. And this was friends and family money, scraping together pennies and literally deal by deal trying to do this. And had enough of a track record that in the 90s, they took a page out of the venture playbook and approached institutional investors and created a fund that is a serial fund that is entirely institutionally backed.
Wow.
This was at a time when none of these investors had ever heard of venture debt because it was literally just created. They created it. There wasn't even a name for it. It was just, hey, there's a debt for startups, and these two guys found a way to do it and think it's interesting. So, you fast forward now 44 years, we've raised 10 institutional funds on top of the 7 early funds in the 80s, so 17 funds. And the business hasn't changed much over that period of time. The kinds of companies have changed, but ultimately we back interesting people doing interesting things and trying to create large markets. And so we've got a slightly different product than venture equity. I liked your booster pack. I know we'll get into some of the details, but it's that we add complementary capital to equity that helps companies go further than the equity itself.
Nice.
It lowers the total cost of capital that companies raise, and that's been the bread and butter of what we do.
So David,
Yeah,
I'll pause you right there because I do want to pull apart the things around venture debt. And
yeah,
it might seem once we get there that we're going baby steps and overly simplistic, but I've
no
found
problem.
in venture capital, it's much better to go overly simplistic than assume
Mhm.
people understand what's going on. Before we get into that, just want to mention for myself, as you were talking through the story, and for everyone else, like not even just venture debt, but venture capital and any sort of um, entities, firms associated with the financing of early stage technology and startups. That's quite a track record for anyone. The very few brands have been around that long when it comes to venture capital. So that's something I didn't know about WTI. Would any of the people on the call recognize any deals that the firm has been a part of? Is this something that is like, I'm just trying to get at it. Is this something that
Yeah,
are,
yeah.
that are in the dark corners of,
No,
not
no, no. I mean,
news
it's a
or?
good question. That's a good question. So most people don't know that we were the first institutional investor in Facebook. That's an interesting fact. We were brought into that company by Sean Parker when the company was still in the dorm in Mark's dorm in Boston, and we're moving to Palo Alto. Mark or Sean had worked with us at another company, and one of the things we'll talk about is sort of, what happens when things go wrong. Well, Sean's prior company, things didn't go right, but he had a great working experience with us and said, "Hey, wait a second, this kind of capital is really the jet fuel to companies that are growing, a la your jet pack." And he brought us in at the same time that Peter Thiel wrote his angel check. And so we got in and invested 300K of debt alongside Peter's angel check of
Wow.
500K. And so we most people don't know
Did
that
okay on that one.
of
Yeah.
that story. Yeah, 5 million pre. So that most people don't realize that we were investors in Google's Series A alongside Kleiner and Sequoia. We backed and built their first server farm when they were, the eighth uh, um, search company in the world that people were, wondering why in the world we need another Alta Vista or a Yahoo or whatever. It was, two interesting guys from Stanford. So a lot of times people don't know that name. We've been involved with Palantir in the early days of Palantir. We've been involved with a lot of interesting companies that over the decades that are kind of creating new industries. It's one of the fun things of our job is we get to play a role sometimes in the creation of new industries. And
Totally.
over a 44-year period of time, you don't get them all right, but there have been some fun ones that people do know.
Awesome. Well, I think this is probably news to a lot of people who didn't understand what venture debt was before we even started talking. The fact that some brand name startups and now behemoths used it on the path towards becoming gigantic businesses. So super helpful to know. Um, this is not all about WTI. We're actually here to milk your brain and kind of walk us through a little bit about the basics around venture debt. So I did want to start with something pretty simple. And it is this general question of, what is venture debt? And again, I used AI and I said, give me a abstract image representing what venture debt is. And this is what it came up with. And I think it's relatively accurate, at least in my head, because I'll tell you, I think I know what the word debt is when it comes to financing. I think I understand venture. I was a venture capitalist. I wonder if I could push you to sort of describe venture debt at its most basic level and
Yep.
assume you are speaking to one of the least sophisticated people you've ever met, not too far from the truth,
Yep.
so that everyone else can kind of benefit from you talking to me like I'm
Sure.
like a child. So let's start there. How would you
Yep.
describe venture debt, and then I'll play along to help tease out some of the more important details.
Yeah, sure. I mean, at its most basic level, it's a layer of debt capital that's added to businesses who have raised some form of venture capital, some amount of venture capital, with the notion of adding runway.
Okay.
And the idea by adding runway is that the company can extend their life, and have more time to hit milestones, more time to let things play out. Well, one thing that startups can't control, that's the most out of their control, is timing. And so
Yeah.
it could be timing of, new product introduction, timing of customers coming on board, timing of a clinical trial getting fully enrolled, and what have you. When you're sort of out in the ocean floating around on your little raft as a startup, the thing that you can't control is those giant forces that are working against you. And so at its most basic level, venture debt is capital that is additive to your runway. It's paid back over some number of years thereafter. That is designed to just help you get further along in the equity you've raised by itself.
Okay. Great. That was a good setting of the stage. Now I'm going to pull some of these things apart because the dynamics of how venture debt come in actually I think are quite important for people to understand. And I just want to like sort of underline parts of your sentences so
Yeah.
we're certainly clear here. You start off by saying venture debt is a type of financing capital that comes in alongside venture capital. And I want to be clear here. Does that mean that venture debt, uh, as you understand it, can never be taken on unless there is a venture capital round being put together? Like, how should the founders on this call think about timing of when venture debt is a source of capital?
Yeah, I mean, I'd say most lenders probably want to see that there's some professional equity in a business. I would say it's not purely a requirement. We've done some transactions for bootstrapped companies who've gotten themselves profitable and have built enterprise value. But I'd say that those are more rare. I'd say most if we're again zooming out to the most basic level, most lenders will want to know that there's some professional investors that are invested in these businesses. Venture lenders do not take board seats. They're not usually doing deep dive customer diligence. So a lot of times the notion that there are professional investors involved that have made a decision to invest equity is a bit of a signal that there's been some professional diligence involved in at least understanding these businesses at some level, that can validate that this is a worthwhile investment. It's not to say that that's the only diligence done, but I would bet most people that are in the venture debt industry would say they want to see some professional capital. It's not always the case, but most of the time.
Great. I think that's super helpful. The next stage of it, I joked around about saying that I understand the word debt, but debt is something that I think we need to pull apart for everyone here. How do you access debt? What does debt look like when a company has access to it? And I'm not even talking about venture debt. We're just talking
Yeah.
about what is debt. And
Yeah.
so I think what's important to hear is let's talk about what debt is as a form of capital.
Yep.
It's a loan, right? As in
Yep.
when you get equity, right? The expectation is that you don't pay back the money that they borrowed on certain terms. They just own equity in your company. A debt is a little bit different. And then maybe you
Yep.
could talk about the idea of having lines of credit
Yeah,
debt,
there's
because I think that
sure.
dynamic is how the two really play together, and that should unlock some thinking from the
Yeah, I mean, as we get further into this and we start narrowing down the different the details here, because the devil is in the details when it comes to a lot of these things that I'm sure we'll get into. But you're right, it's a promise. Debt is a promise to pay, right? So it's you're signing a contract that says I'll borrow X amount of dollars and I'll pay them back under, Y terms, and Y could be monthly, it could be all at once at the end of a term. I mean, all of that stuff is negotiable, but generally in the venture debt world, you're paying the loans back over a 2 to a 4 or 5 year period of time. And those payment schedules are usually dependent on each company. They're bespoke to the way that the company's set up and the individual aspects or the cash flows that are appropriate for that particular company. But at its most basic, it is a promise to pay. There are some collateral that goes along with it. So you are pledging certain assets to a lender as part of the loan that, should you not be able to pay, that the lender is able to use those assets to help recoup their investment and reduce their exposure.
what are some examples of that?
Well, I mean, most of the time for the stuff that we're talking about, it's one of two flavors. I would say generally it's all of the assets of the business. So most companies in today's world are asset light. So they're not, purchasing a lot of physical assets. They're usually businesses that are cloud oriented and or asset light. So in that sense, it's essentially you're pledging everything, and mostly that's intellectual property. It's sort of intangible assets, and that's a legal term. Intangible versus tangible are things that you can move and sell independently. A chair, a computer,
Yep.
whatever. There are some forms of capital that are equipment loans. So there are sometimes people will do for heavy asset rich businesses, there exists a form of capital that, well, they'll just lend you money against the actual equipment. But I would say by and large, the venture debt business is capital that's being lent against the enterprise value, which is essentially you sign a piece of paper and saying, like, literally all the assets we have, whether they're the desks and the sofa behind you, Jason, and
Mhm.
the books, or the IP, the computer code that you are using to populate your service, all of those things.
Got it. Okay. This is a good transition to the sort of second category of question, which I couched as who invests and why. Um, you already talked a little bit about, who WTI is. There was a question in the chat about, wait, paid by whom to whom, like a VC to a startup. I think, at its basic
Yep.
level, Vlad, like, wants to understand
Yep.
who are venture debt providers, like,
Sure.
is an investor. And then, after you answer that, I want you to talk about what WTI or other venture debt providers are expecting. The idea of being paid back.
Hmm.
Let's go more specific. And what are the ways? I'm sort of leading as a leading question, but what are the ways that venture debt providers get paid back? Because if we don't get that sort of specification, I think founders may get confused around how they should be thinking about their own revenues, whether, oh, now I owe you guys, and so how is
Yeah.
that, like, actually helping me? So
Sure.
first
Sure.
two, and then why/what are you guys betting on? Okay.
Yeah. 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 So who are the types of lenders that make these kinds of loans? There's a variety, there's a spectrum of folks that do it. Um, we're an independent lender that operates out of a fund, like a venture fund. So we have a set of investors that every several years we create a new fund, and they invest in that particular fund, and then we go out and invest that money in a handful of startups. So a private fund is one example. There are some public companies that do this. There are some banks that do this. And then there's sometimes some hedge funds or others that may do this. And at the same time, they may do short selling in different companies. They have a variety of things that they do. But I would say by and large, it's banks. There's some public funds that do this that are sort of specialized lenders. And then there are private funds like us that do this.
Great.
Number one.
And
Number,
then,
yep.
so that's great, by the way. Like, so people should know that there are different entities out there that will provide this type of product, if you will. WTI is one of those, but there are other options out there if you start considering venture debt as a portion of your fundraise, your capitalization. So then maybe we could talk a little bit more about what venture debt providers, in particular, you all are expecting, and what is the general, what is the general expectation of how you guys get paid back? What are the down the
Yeah.
middle?
I mean, ultimately, we get monthly payments. So we will set up a payment plan with each company where they're paying us back. And this is the same with whether it's us or anyone that's in this space. You're signing up to a series of payments. The payments aren't royalty payments. They're literally fixed payments that you're agreeing to a payback schedule like a mortgage, where you sign up for a mortgage and you pay it back. The bet that the venture lender is making is that the company, with this capital, with their team, with the technology, with their investors, are going to continue to raise additional capital. I mean,
Yes.
that's ultimately the bet that we're making. The bet that the entrepreneur is making is this money going to help us raise capital at higher valuations that make taking on the debt worthwhile? And is it going to be cheaper for me to blend in this capital than if I finance the business entirely with equity? Those are the two bets that each side is making when it comes to entering into a transaction like this.
Yeah, they're good. Actually, your brilliant colleague Daniel helped me understand this a little bit more as we talked about it. But it's this idea like, um, I think it can feel weird for a founder to hear this. It's like, you're lending me $1 million, David, but now you're telling me to pay you back. So I'm paying you back on a monthly basis the money that you gave me.
Yeah.
But if you think about the delta between your payments and how long it actually gets you to get to your next fundraise or potentially a profitability, but your next fundraise, then that's the sort of bet that we're all making here. Is like, if I raise $5 million from Andreessen and I'm doing some math and I'm thinking, what would it be like if I had 6 million? And what's the cost of capital between equity versus debt? I think this is the thing that I want people to understand when it comes
Yeah.
to what that calculus looks like. Okay.
Yeah, I mean that's right. I mean that's the right way to think about it. There's another nuance that we can get to in a second, because not all venture debt's created equal. And I know there's a lot of comments in the chat that we'll get to that make as I said earlier, kind of the devil's in the details about who the capital comes from, how they're structured, what are the loan terms. I mean, all these things really matter, but in terms of the basic calculus, that if you're able to use all the money, if the structure works out in your benefit, and we can get into like, well, when does it not, and when does it, and what are some of the pitfalls to avoid and things like that. Ultimately, the way I describe this to founders is, we help you own more of your own company. So if you ask companies at the end of the day, that I've been doing this for 25 years, and for founders who cross the finish line and they either exit the business through an IPO, or they sell the company to a larger company, at the end of the day, a lot of times, if you ask them, okay, what would you do differently? They said, well, they would normally say, I over equitize the business. Like, I don't own enough of this business at the end of the day. And for me, having spent 5 years, 7 years, 9 years, whatever, running this company, to end up crossing the finish line, and I don't own that much of it. It wasn't, I don't have a lot to show for it.
Yeah.
So if I go and do it again, I'm going to be more efficient than I was the first time. One of the ways you can do that is by using capital that's cheaper than equity, and using it responsibly along the way. So a lot of the companies we work with over time are blending us in at each round in order to blend down and not take as much equity at the end of the day, so that they own more of the company at the end. And it's accretive. By the way, it's not just accretive to them, it's accretive to all of their shareholders.
Yeah.
So
David, so we're just coming up on the half hour. I wanted to check
yep.
to see if you have a hard stop.
No, I'm good.
You don't. Okay, cool. Just to let you know, we have a number of founders that are going to join us because I don't want this to be a one-sided, like everyone should take venture debt at all times, not biased at all, David. And so we're going to transition a little bit to inviting them up. But as
Yeah,
we do that, the sort of next topic that I did want to make sure we spent a little bit time on was this idea of, you know, what is the dynamic with venture capital and what are these terms? Essentially the terms, right? Like someone in the chat asked about, is there a penalty for early payback? We were not going to be able to get through all the details around structuring venture debt and what the terms look like. But before we bring the panel up, I wonder if you could, one,
I,
maybe answer, is there a penalty for early payback? I would be
yeah.
curious about that too. And then maybe like one or two of the
I think
main terms people need to understand.
Well, I think the biggest thing that people need to understand is that not all venture debt is created equal.
Okay.
If you really want to boil down, sometimes people think that the biggest mistake that people make is they think that all venture debt's the same, and they think about putting, lenders into a matrix of cost and thinking, okay, I'm just going to pick the cheapest partner. Um, and avoiding the fine print. And I'd say that there isn't a financial product on the planet that is risk preferring and low cost. Those two things don't work together. So the biggest thing that founders can do, and folks that are looking at and evaluating venture debt, is to evaluate all of the terms. The non-financial terms are the most important, and these are terms around covenants and defaults. So it's essentially what can go wrong and what happens if it goes wrong. Are lenders able to sort of swoop in and put me in default and demand their money back? And
Yep.
those things are where you should spend all of your time, because the financial terms don't matter if something's out of your control and all of a sudden you have an email or a call from a lender that says, oh, item 17J in the term sheet or the loan docs has been triggered and we want all our money back.
Yeah.
Um, those things, and that is where the rubber meets the road in this space. I'll first, like, advertisement here. We don't use these covenants. We are one of the only firms on the planet that does not use financial covenants of any kind in our deals. It's been foundational from day one. We don't do it. But those terms really, really matter, because if you've got a lender that demands their money back right at the time when you need to use that money the most, you're most vulnerable, and it can kill your company. So when you get to that point, like, those are the kinds of things that you really need to seek counsel on. You need to talk to other founders who've been through this. Do your homework on the terms. That's the biggest advice I would give anybody that wants to, pursue this.
Really appreciate that, David. That's a good little baseline here. What I'd like to do is transition over to talking to a few founders, and knowing that we'll have David in the room at the very end. We're going to go back to set kind of open Q&A so that either David or some of the other panelists can talk to us a little bit about the specific questions that you have. What I want to do now is actually talk to a few founders who have made the decision. And I want to make sure we ask things like, what did you do? And what were you considering? What were you worried about? Like, there is a side of this that is always, there is some kind of anxiety or doubt whenever you partner with any sort of source of capital. So excited to have Spencer Hutchins. These are all founders, by the way, founder of Concert Health, who, and I'll tell you what Crunchbase said he raised. He can tell us more. We have Spencer Hutchins, from Concert Health, who raised $58.5 million. We have Adil Malik from Humming Homes, raised $10.7 million. Philip Charles Pierre from Semsi, who raised a Series B, unannounced how much he raised, which is awesome. Couldn't figure out how much he raised. And then Daniel Hackhoff, who has a great perspective here because he's raised, I think, over $30 million for his company, Pitsy, but is also a venture partner at WTI. So, Paige, could you help me spotlight them? We're good. Let's see. We've got Spencer here. I'm going to take David off. Spencer, where in the world are you calling in from?
Hey, great to meet you and see everybody. San Diego.
Awesome. Let's see, Philip, where are we calling in from?
New York City.
New York City. Daniel, you're in Los Angeles. I can see that
Sunny
background.
LA.
Awesome. And Adil, you are also New York.
Yes.
Amazing. Okay, so what I'd love is to just go around the horn, and this will give us all an opportunity to just kind of think about what our answer is going to be. But essentially, eventually, I'd like to have all of you talk a little bit about when you took on venture debt and what sort of the decision matrix was for you. But to start, if we could go Spencer, then Adil, Philip, and Daniel, 30 seconds on your company, just so we know what your company does. Don't sell us on it. Just tell us what Concert Health is, and how much money you raised in venture debt. And that might have been split across rounds, but yeah, if we could just start right there, that'd be awesome. Spencer?
Yeah. Concert's a growth stage behavioral health medical group that works to integrate uh, behavioral health services into the primary care setting. So we employ a few hundred therapists and psychiatrists and work with the biggest health systems in the country, care for about 100,000 people.
Awesome.
We started the venture debt when we raised our $8 million Series A in COVID, put a couple $1 million facility together then with Silicon Valley Bank, and then did a upsize that round when we raised our Series B in 2022. We raised 40 million of equity and put a headline 20, actually $10 million facility together in terms of those. And I'd say in both of those, our business is one where we have a lot of accounts receivable. So healthcare gets paid behind and our health systems have to pay us. And so we've done both classic term, which is like, this is just how much you borrow. And we've put lines of credit together with as well based on a formula for how much accounts receivable we have.
Awesome. And the second go round, did you re-up with SVB or did you use other?
We did, yeah, we did. And then we went through a additional process when SVB collapsed to decide what was going to happen in the moment of whether or not the bank we owed some money to existed anymore. But they ended up holding on to us. We got some other term sheets, but stuck with them.
Awesome. Super helpful. Thanks, Spencer. Adil, could you share the same? 30 seconds on Humming Homes?
Sure thing. So my name is Adil. I'm the co-founder and CEO of Humming Homes. Humming Homes is an AI-powered home manager built for the everyday homeowner. So our product anchors on effectively delivering a triple A-like experience for your home. So emergency services, booking, home service trades, getting personalized information tied to your home, et cetera. And we've raised, like Jason mentioned, close to 11 million bucks. We raised a $1 million venture debt facility from SVB during the time of our $8 million seed round.
Awesome. Okay, super helpful. Philip, can you tell us a little bit about SMC?
Yeah, so we are an insurance, small commercial insurance platform, essentially connecting insurance agents with carriers. And in doing so, we've also created a really dynamic marketplace, helping those agents access additional markets for our small business owners across the country. You are correct. We do not publish, and it's more of a Philippe thing. We don't publish how much we raise because I think it's a silly game. However, I will say that we did get a 5 million from WTI as part of our last round, after our last round, which was a Series B.
Series B bolted on 5 million from WTI. Great, awesome. And then lastly, Daniel, tell us a little bit about Pitsy and the decision, or not the decision yet, but how much you raised, if you can share, and what portion of that was venture debt.
Yeah, sure. So Pitsy is a cell phone insurance business based in Brazil. So we provide protection plans for Brazilian consumers against getting robbed or having their phones break. I wish I had taken venture debt earlier, candidly. We ended up raising venture debt just after, about 2 years after our Series C. So all in, we raised almost $30 million in equity. We got to profitability, but kind of, break even profitability. But our buffer, our balance sheet at the time, we had, a pretty small reserve in the amount of cash that we had on the balance sheet. And so as a result, we were really threading the needle of all the investment opportunities that we had at Pitsy. And so we were saying no to a lot of opportunities that we probably should have said yes to. But at the time, our valuation was, $150 million something, and we needed maybe $3, $5 million to make some of those investments, which is a very awkward amount of money to raise equity because no venture capitalist really wants, 4% of your company.
Hmm.
And so we ended up raising venture debt with WTI, who is less, ownership sensitive and more, creative in how they were able to create structures. So
Just
we ended
putting
up
money
doing
to
the
work.
$5 million facility and went on to do another 3 different deals with them.
Great. So I think that's actually a good segue into what I'm trying to tease out from people, which is the decision-making framework, right? And I'll just stick with you, Daniel, because of something you said. You wish you took venture debt earlier. Did you not take venture debt earlier because you didn't think about it? Or did you think about it and incorrectly made a decision not to do it? Tell us a little bit about your decisions to capitalize Pitsy early on.
Yeah, I hadn't heard of it, candidly. It came up when we had this issue at the board level. We were thinking through how are we going to raise $5 million? And we were thinking through, should we go do a big equity raise and raise 25, even though we had no idea how to put the extra 20 to work. And so decided against that. And people suggested, well, why don't we talk to some venture debt providers? It seems like a good fit.
Yeah.
I wish I had done it earlier because it would have allowed me to own more of the company. I could have bridged to a higher valuation and then raised more equity when my valuation was higher.
Yeah. Philip, I want to go to you and ask you when you went to your Series B, you didn't do it with your Series A. Sounds like you did it with your
Yeah.
Series B. Similar or different reasons? Did you just not know about it at the Series A, or you heard about it and just decided not to do it at the Series A? What was your decision?
Sure. So yeah, we did know about it. We just didn't think it made sense for us at the time. Maybe that probably we could have done it in the Series A, but it made more sense in the Series B because we just had a lot more traction. The business we're building is capital intensive and does take time. And by the time we hit some really interesting metrics in around the Series B, that's when it made more sense for us.
So Philippe, I'm not gonna let you off the hook here because
Please.
the that statement is exactly what I want to hear, which is didn't make sense. What is not making sense? What was not making sense to you? Because to me, that indicates an amount of risk. You're like evaluating some kind of risk and or something, maybe deal terms. What about it at the Series A did not make sense to you?
Yeah, so I think a couple of things. One, we thought the deal terms would be a bit stringent based on where we were from a revenue perspective and sort of where we saw the business going. That's really the balancing act for us that we were thinking. And by the time we got to our Series B and past our Series B, we thought that our business was at a mature enough stage with enough revenue, and the outlook seemed like, hey, we can actually pay this thing back
Yeah.
and make it work for us. That's when we felt the most comfortable. I thought about it in the same way that we think about a mortgage for a home, right? My wife and I have generally bought really nice homes that we can actually afford, not the ones we hope to afford in 5 years.
Got it. Got it. Maybe to Spencer or Deal, and I'll put out this thought or this thing that I've heard, and we'll try to hold David back from chiming in. You guys know who David Sachs is around All In podcast. He's famous for kind of being extremely negative towards any types of debt. And my own thought is like, were any of you going through this, like being like, I don't want to take this because of a scary outcome or something that you don't like about venture debt? Spencer or Adil, do you have any thoughts or things that come to mind when I bring up this concept of scariness of venture debt?
I think it's a great question, and I recently listened to what he had to say about it. I think it really depends on timing, actually. I think Philip mentioned this, when it's right for you. Um, to be totally candid, so I did have an investing background, but I was not as nuanced on venture debt as I probably could have been, should have
Dude,
been
there are
at
venture
the earliest
capitalists
stage.
in this call right now. I won't
Yeah.
call them out.
And I believe it was framed in a way that wasn't prudent for let's just say, like, I'll take myself as a first-time founder. So your pre-product market fit, even though you raise a lot of money, your pre-product market fit, you know, your revenue, your traction, your ability to say, yes, this thing is working, and I know my unit economics, I know my payback period, I know my customer acquisition costs, I know my operating leverage. There's still so many question marks, and it was framed to us as, hey, you're raising 8 million in equity. We have a great, you know, partnership with your lead investor. Let's tack on an extra million for runway. And I think that it really was, I don't want to say, at the time in 2021, it was just a very different period when it came to capital raising, right? Interest rates are low. Founders were, you know, being offered pretty attractive term sheets. I think it's really important to understand the downstream challenges, both from like a business perspective, public markets perspective, valuation perspective, and like your ability to like be really strong during your next capital raise or during an exit even, right? A lot of businesses that are looking at strategics or M&A or even future capital raises, it does go into account like, can you make the right decision within a, let's say, contracted time period, right? If you're running out of capital, when you also have to make 40, 50, sometimes $60,000 a month in payments. That could be, we're talking about like, if you have a small team, you're talking about like between 4 and 6 people that you could potentially either have on your team or be making payments toward venture debt. So to me, it was framed, you know, as I was getting up to speed slightly differently, and I used it in a manner that I probably wouldn't do again.
Great. I'm glad we have at least a different perspective on that. Spencer, you did it multiple times, right? I think maybe you were one of the ones that calculated this through from the very beginning, so you incorporated it in. I wonder if you could talk about like sort of the biggest driver for you to continue to make these decisions. It sounds like there's an obvious asset that you can collateralize with your business and AR, but you know, is this something that you would consider in almost any business that you run?
Yeah, I think the market is pretty robust at this point, and it can be worth it. I do think you have to think about, it's like a whole nother process, right? The time to do it is almost always immediately after you've raised an equity round, right? The only time that you can raise otherwise is if you really are at profitability, right? You know, because they have to underwrite to something, and better to underwrite to a new investment syndicate and a balance sheet. And it is important, especially early, if you don't have like a CFO yet or someone really capable. It's probably half as taxing as an equity finance, but it's a whole other process that takes you away from running your business as you understand and drive to these things. But I thought about it in a few angles. One, our business to maintain growth is always going to need some level of sort of financing at AR. And so it's like, let's get in the habit of understanding how to do that and putting the foundations together. And the second, yeah, is I think it's sort of a, if you can get attractive terms, you often don't even need to draw the capital for a period of time, right? You know, and so you're giving up some warrants for that, you're giving up some fees, but I do think it can change the scheme. I mean, the important thing to do is sort of like pretend you don't have it, right? You know, sort of don't just think about it as an extension of equity, but think about it as a safety blanket. And there's a bunch of advantages, to Daniel's point, if you're getting close to profitability or at it, to make investments around it. And I think another is, founders that get close on capital, right? You know, if you could sort of say, I don't need to get screwed in this equity deal and there's something else because I actually can make payroll for another 60, another 6 months or another 9 months because I can pull that, or I can use it. It has costs. You have to pay it back, right? You have to give some warrants. You have to, you have some fees on other sides. So I think it's important to think about it like that. And ultimately, as a founder, if you're going to choose to run a cash incinerating business, that sounds like at least many of us have done for a phase, and I'm still doing, just like understand how it is your investors make money. I think from an equity investor, particularly, they understand some of these go to zero. And so it's like not the worst thing possible, and when you're borrowing money, they don't have the same upside, right? And so it's like, no, you're really supposed to get this money back. So like, it's not just like, sorry, like I never raised the next capital, like I'm just going, that can happen. But it can be, it's like, think about you are very confident you can sell the business or, raise more capital or stop losing money and be able to make the payments back, and be serious about those plans before you take it.
Super helpful, Spencer. These perspectives have been really helpful. I want to transition this a little bit to opening it up to the audience. And David, this is when I'll sort of add you back in. This could not be a better council of elders, to really get us on the right path if venture debt is something that you're considering. To warm things up, I still want to stay on this topic of like, what are the scary situations that exist when you have venture debt? And I understand that WTI has a product that doesn't have the covenants that might make more things scary. But Davies early on had this line, which I think a lot of people believe, which is debt is almost never patient. That's what someone wrote in the chat. I think in a high level that feels right to me directionally. And a deal, I'll try to interpret what a deal was talking about, but I think there are situations where you have your capital that you raised in equity and you've bolted on whatever in venture debt, and you're operating your business in a certain way, right? Certain amount of burn, and you're getting to the end, and all of a sudden you have to adjust, right? You have to pull back on spend. You have to pull back on things in order to figure out how you get to the next stage. But you have these payments, and that's something that you can't, are hard to pull back on. Is that anything that any of the founders had considered? Or if, just so Daniel can kind of change hats pretty easily here, Daniel or David, maybe talk a little bit about this idea of debt being patient, and what are the scary situations, and how should founders, if you are as objective as you can, how should founders think about this?
Yeah,
You go. Yeah.
Sure. So I think one of the important distinctions is just kind of how much debt you're taking on is a really important piece that we don't talk about. Sometimes we think about it as kind of this binary, should I have debt or not? I think everyone on this call has a credit card, and that is a debt vehicle. You're promising to pay in 30 days something. And so it's a tool that you can use. And I think where you get over your skis is if you take on so much debt or something that was unexpected happens in your business. And then I think what's really important in that scenario is who are you working with? Because there's no debt provider that wants to like take over your business and try to run it for you. Like if you run into issues, they're going to try to figure out something to partner with you so that you can work it out together. And there are some folks who are like banks that I think are probably a little bit scarier in how they think about that situation. And that's why they use covenants to try to kind of get ahead of situations and can lead to very scary situations. And then you have others who think a little bit more like equity investors. And I'm biased, but WTI is one of those. And they just try to work through it with you. And so I've been a party to a number of scenarios where the business is not quite going to plan. And you sit down together and you figure out, what do we do? Do we raise money? Do we kind of restructure things? So I think I think patient capital is probably actually closer to reality when you have the right type of partner. But I think that's true in the venture capital world too. You can get bad VCs.
Yeah, I like the call out that you can misuse debt. Like I've never had problems with credit cards, but I do know a lot of people that have had problems with credit cards, and so it's how you use it a little bit. Daniel has a good question for Spencer, Spencer, because I think explaining how you think about this and how it impacts the way you run your business and how you take on venture debt might illuminate some things. So Daniel asks this idea of it's important to understand how investors make money when taking venture debt. Why is that important? And what did you think about in terms of the way David makes money?
Yeah, so early stage equity investors are used to zeroing a lot of their investments, right? It's like, didn't work. That's part of my model. I'm doing a power law. The debt has much less upside. Normally, they have warrants that are normally in the basis points, right, of the company versus 10 or 20 or 30%, which also means the upside's less. And sort of there's this preservation of capital, right? They're not expecting to have common write-offs, meaning like, they are structuring this because they think it's likely to be paid back. And I'd say watching that, certainly if you pulled debt and your total cash goes below the amount that you owe back, right? When the company itself can no longer pay the credit back. That's when stuff gets nervous. That's when you want to understand the covenants in your deal of sort of like, can they literally shut you down and say like, hey, I just got to get my money back because you owe me 10 million. You've only got 10 million. I'd like it back, right? And then essentially ending, or along the way they want to be communicated with, right, as they are essentially taking more risk if you're in a low liquidity situation. So you want to understand that both from their culture of them and others, and think about that. I think one element too happens a lot in this stage for growth stage businesses where they raised at a very high valuation in their last one, and everyone is sometimes using debt to sort of like get to the new comp, right? Like how can I avoid? I think one thing that's really important, and this can be used either way, but it's really important as a founder to know, like, are your current investors going to put more money into your company? And like they just don't want to figure out exactly how much the price is, but they're definitely going to fund it, right? That's one thing in which you can sort of like everyone can get comfortable of just like, hey, I don't want to take the markdown, or I'm figuring that out with the founder. And that's very different from like, you do not have the ability to pay your own bills, and you do not have a current equity investor that's planning to wire you more money to help you pay for your bills. And that's a place that the founder is a lot more at risk. And it's a place where the debt fund, if you've taken one, or the bank, should have more nerves, because it's like, okay, now we're all betting on this sort of ability to go raise capital from someone who's not around the table. And I think having a realistic view of that's important, when you decide to pull it, when you start your capital raises, things like that.
Helpful, super helpful. So we're butting up right at the hour, and this has been a super packed hour of information, which I think is super helpful. David, I'll just call on you one last time. At some point, I think a lot of the people on the call will be considering venture debt, and I can't remember if it was Spencer or Philippe that talked about the idea of another process that they have to run. And it's like you're closing around, and that's when you have to think about venture debt. How should people think about making decisions on what firms to work with? You are going to be super biased, but I get it. But like, I know what it means to go choose between a bunch of term sheets in venture capital. Are there things for people to consider around when, what type of firms they should work with on the venture debt side of things?
I think it boils down to, if you could, number one, you can do your homework and ask people in your network and ask about their experiences. And as people on this call were saying, the first thing you can do is ask for references of like, hey, when things have gone wrong, give me only references where things have gone wrong, or things have not gone to plan. I want to talk to those people, because that's when you'll really find out the stories about how people behave. So on one hand, there's that. I'd say, and it's pretty cool. You've got a really nice network of folks that this group can tap into, and they can start asking each other questions. It's not hard to find people that have used venture debt, and you ask about the good and the bad of those stories. In terms of like the advice I give people is in terms of how are people going to act, and what is the process like, and what kind of risk are you getting as a founder, is understanding where's the money coming from. Where's the money coming from that the lender is lending? A bank is lending people's deposits. They don't expect to lose money with those deposits. The government doesn't really allow them to do too many risky things. So you will end up with what looks to be cheaper terms that are tighter on the structure and covenants. On the other side of things, if investors have, and you should ask this question, where does your money come from? Like, whose money are you investing? On the other side of the spectrum is capital that's coming from private investors that realizes that they're taking risk and understands the risk, and you're going to have more flexible terms. So there's a spectrum of venture debt that is it all comes back to where's the money from, and what kind of risk are those investors seeking, or those folks providing with that capital. That's ultimately what it boils down to.
Awesome. David, and the rest of the guests, thanks so much for finding time to do this. I think this is super illuminating. Certainly for me, a lot of people in the group. I did want to make sure that before we leave, I told people a little bit about the kinds of support that we want to share with people. And it comes down to a lot of what David talked about, which is, we said, oh, we have this network of people here to ask questions about. That is where you should be getting a lot of help. So find people in your network who you can ask these questions on. You don't have to fly blind. You don't have to fake it till you make it. Just as a small plug, my company Adamant, which is largely a media and education company, we have been pushing out new ways to support founders. And so we do have a poll afterwards. We would love for you to fill that out. We will be following up with a recap email with a lot of this stuff. And I saw a bunch of questions in the chat that we will try to address a little bit in the recap. So don't worry about that. Just so you know that we have been shifting our expertise to be able to support some of the biggest pain points that we hear people have. This one sounds small, but a lot of people ask about deck design. So we are actively attracting some of the best designers, combining it with our fundraising expertise and helping people with deck design. We have an investor research service, and now we have a community and program around Adamant fundraising so that you can access other people who have used venture debt in the past, who have spent time with other investors. So look out for that information. We really appreciate you guys showing up for events like this. Let us know if there are other topics you want us to do deep dives in. We'll do our best to draw experts like David, Daniel, Philippe, and everyone else here in order to get you guys what you need to know and make fundraising a little bit easier for all of y'all. All right. Have a good rest of your day. Thanks again to all the guests, and we'll catch you next time. See ya.